Hello everyone, welcome to my channel Sujit Patra Ekdam Real Estates. So we have discussed many of on my video about many aspect on real estates and finance also. So this time actually we will discuss a very hot topic and interesting topic, that is capital gain tax. So what is capital gain tax and how it is calculated? What is the cost of indexations? So all the things we will discuss in this video, because in our daily life actually we come across many questions from our friends, relatives and from other circles. What is capital gains, what is and how it is calculated, and what is the income tax implication on it. So all the things are applicable on the capital gains. So what is capital gains? So capital gains is arise when there is a gain on the sale of any capital asset. So that is called capital gains. So we'll discuss also how to avoid the capital gains tax. So please view my channel thoroughly and completely and watch it till the end. So we'll able to understand what is capital gain tax and what are the exemptions under different sections of Income Tax Act. So please listen the video carefully and watch till the. So the capital gain tax is the sale of any capital assets, that is the income when you generate from by selling any capital asset. So that income is chargeable under Income Tax Act. So this profit or the income which is generated through capital gains, and obviously that will be treated as our income. So that income is chargeable to tax. So but there are different types of capital assets, like your land, your building, your shares, your patents, your trademarks also falls under capital assets, and then jewelry, leasehold rights, machinery also, and vehicles. So all the things are falling under capital assets. But there is a catch. What is the catch? There are certain list of capital assets which does not fall under capital asset also. Suppose you are using any consumables or raw materials for your business purpose or for your own professions, so that will not fall under capital assets. Suppose you are using your for your day-to-day operation, you are using any raw materials, so that raw materials will not fall under your capital asset, because that is used for our day-to-day operations. Similarly, your personal belongings like your clothes and your furnitures, all the things are not falling under capital asset. And the third one, the asset which is agricultural land. If the agricultural land is in a rural area, so then also it will not fall under capital assets. So there are three assets. Please make it a point that there are three assets which are not falling under capital asset category. So we have discussed there are two types of capital asset. One is short-term capital asset, the other one is the long-term capital assets. So what is short-term capital assets? So when we are holding any capital assets for less than or equal to 36 months, it is called short-term capital assets. And the sell-off period should be the 36 months is the breakup period. The cut-off date is from the date of buying only. So that means the holding period should be treated as 36 months from the date of buying. But in certain cases, the holding period is reduced to 24 months and 12 months also. In cases like wherever the immovable property is there, like land, building or house, then the holding period will be considered as 24 months, not 36 months. See, that means if you sell off an immovable property within 24 months of buying it, it would be called as a short-term capital asset. Similarly, equity shares which are listed on the recognized stock exchange like Bombay Stock Exchange, National Stock Exchange, that is NSE or BSE, where the holding period is of 12 months, and if you are selling before 12 months of your purchase, then also it is called, it will be treated as a short-term capital assets. Similarly, the other point is that long-term capital assets. If the holding period is more than 36 months, then it will be treated as long-term capital asset. But immovable property sold after holding period of 24 months will be treated as a long-term capital assets, and equity listed in the stock exchange, if it is holding period is exceeding 12 months, then it will be treated as a long-term capital asset. Now we will discuss about what is capital gains. So depending upon the nature of the asset, like we have discussed short-term capital asset and long-term capital asset, the capital gains is also like short-term capital gain and long-term capital gain. So that is in short form it is called STCG and LTCG. So what is that short-term capital gain, that is STCG? The profit you earn when you sell off your capital assets within 1 year of holding, then it is called as the capital asset. But what is the rate on that STCG or the short-term capital gains? If security transaction tax is applicable, then the STCG rate is 15%. If security transaction tax is not applicable, what is the security transaction tax? That means the while selling any security or stocks, some tax is applicable. If that is applicable, then the short-term capital gain tax is 15%. If it is not applicable, then it will be considered as your income and it will be clubbed with your income. So then the normal income tax slab is applicable. This is for short-term capital gain, that is STCG. Then the long-term capital gains. Long-term capital gains is the profit you earn when you sell up your capital asset post 1 year or more than 1 year. That means the period of holding for different classes of capital assets is varies also according to the asset. And long-term capital gain tax is applicable at 20% except on the sale of equity share and the units of equity oriented funds. And long-term capital gains are 10% over and above rupees 1 lakh on sale of equity shares and units of equity related funds. So now we have discussed about what is capital assets, short-term capital asset, long-term capital, and we have discussed also short-term capital gains and long-term capital gains. But now the question is how the capital gains calculated. So the depending upon the nature of capital gains, the calculation is also different. So for now, first of all, we'll discuss about short-term capital gains, how it is calculated. So generally it depends upon the full value consideration. That means at what rate we have sold that short-term capital assets. Then we have to deduct our cost of acquisition. Cost of acquisition is at what price we purchase that asset. So that is called cost of acquisitions. And cost of improvement, that means any improvements, repairs, renovation, or any improvement we have done in that short-term capital asset, that also we have to deduct. So that means the selling price less the cost of acquisition or the cost purchase price less the improvement cost of improvement or the repair innovation cost about the property, so that we have to deduct. So that is called the short term capital gains. So now we'll discuss about long term capital gains, how the long term capital gains is calculated. So but here the long term capital gains is little different compared to the short term capital gains. Here the expenses incurred for transferring the asset also. Suppose now you are selling the asset, so here the registration cost is involved, the stamp duty is involved. So what are the registration charges and stamp duty involved? So that are also to be deducted from the selling price. And what else is the indexed cost of acquisition. Indexed cost of acquisition, suppose you are holding more than 36 months, definitely the inflation cost is there. So that inflation also we have to factor depending on the year when you acquire the asset and when you sold that asset. So that inflation factor is there. So that is called index cost of acquisition. That also you have to deduct. And the index cost of improvement, because the raw material cost is also there included in the improvement cost. So that also we have to deduct in the improvement cost. And the expenses allowed to be deducted from the full value of the consideration. And more and above that, what are the exemptions? Because that is the catchy point. What are the exemptions under Income Tax Act? Under different sections like section 54, section 54 EC, section 54A and section 54B. So there are different exemptions are also there. So that also we have to deduct from the full sale consideration, so that our tax implication will be less. So now the catchy point is, what are the exemptions involved in our long-term capital gains tax? Generally we purchase one property and we after some time we sell it, and with that price we purchase another property at a higher price. So that falls under section 54 of Income Tax Act. That means sale of house property by purchasing another house property. So here also this exemption is also allowed under section 54. But this exemption anybody can apply in a lifetime, once in a lifetime only for a taxpayer. But that capital gains should not exceed more than 2 crores. That capital gains should not exceed more than 2 crores. So the taxpayer has to invest the capital gains within a certain period. And the new property can be purchased either 1 year before or 2 years after the previous property has been sold. So that is the point we have to look into it. That means when you are investing in another property, this property or the capital gains can be taken under exemption under section 54 when the new property can be purchased either 1 year before or 2 years after the previous property has been sold. And the gains can also be invested in property construction also, because that is also allowed. For construction also it is allowed, but here the construction period should be minimum 3 years from the sale date. So that is there. This provision is also there. Then for profit from investment in certain securities, but this securities has to be reinvested in the new securities within 6 months. Then only the exemptions you can claim under section 54E, 54EA and EB also. Then profit from transfer of investment. Here also, if, the individual should reinvest their proceeds within 6 months of receiving them. So these are the capital gains tax and the exemptions under different sections. So this we have discussed thoroughly, and hope you must have enjoyed this video, because this is a very catchy subject. Because I am getting so many queries about this capital gain tax. So hope you must have liked my video, and hope you will definitely like, share and subscribe my channel and the video also. Thank you.